Good morning, everyone. Welcome to our financial planning Todd talk on inflation. Actually, today it's going to be a little bit more like a Jeff talk as opposed to a Todd talk, because we have Jeff Kaczmarczyk with Blue Rock Financial Group who's joining us today. And before we get started, this is all just conversational. We want to give you some information on inflation. We want to give you some general information on what's going on in the world, what we're reading, what we're seeing. None of this is to be construed as a recommendation for you specifically. As you know, with our financial planning firm, Blue Rock Financial Group, everything is customized for an individual. But inflation is a hot topic right now, and we heard a lot about it as 2021 ended, and we're hearing more about it as 2022 is beginning. So we really want to make sure that we're providing some up-to-date information for you as it pertains to inflation as of right now. So what I'd like to do is give you some background information on Jeff Kaczmarczyk. Jeff is a chartered financial analyst, a CFA. He's the only CFA that we have on our Blue Rock Financial Group team. Everyone else on our team is certified financial planners. So Jeff's background is really deep in the investment side. A lot of good information that he shares with our team week to week, month to month, as far as what's going on in the world. He really has his finger on the pulse in a little bit of a different angle than most of us have in the past here at Blue Rock. So we're super excited to have him on our team. Very excited to have him give his feedback today as it relates to inflation. Also, before we begin, I wanted to just give a little bit of an overview. So what we're going to do today is we're going to go through, what inflation is and how it's defined. We're also going to talk about where it is currently, how we got here, where we're going, what's the outlook based on different economists' position and the market factors. We're going to talk about whether or not a recession is imminent. That's one of the things that we hear a lot when you see the monetary policy of the Federal Reserve start to tighten. So we're going to touch on that a little bit. And then in closing, really, what does it all mean to you? So those are really going to be our main topics for today. And before we begin, I want to give a brief market overview as it pertains to the S&P 500. So that's one of our key indices that most folks really kind of benchmark for themselves as to how they're doing or how we're doing as an economy. The S&P 500 is representative of the 500 largest companies in the domestic United States economy. 2019 was a very good year for the S&P 500, 31.49% rate of return. 2020, it was an absolute whirlwind. Everyone knows what happened in 2020 as it pertains to the coronavirus outbreak and COVID-19 and what that meant to the world that we live in today. But ultimately, the S&P 500 ended up in 2020 by about 18.5%. And then 2021, we saw another very strong year, 26.9% on the S&P 500. And whenever we see three double-digit years, we start to get a little bit antsy, and the questions of bubbles start to come up, especially in light of what we saw in 2008. Also, if you remember back to the tech bubble, we saw some tough years after 9/11. So everyone, has a long memory. At the same time, sometimes we have a little bit of a short memory. So every market's a little bit different, and that's a lot of why we're seeing so many questions. There's always one shoe that folks are looking at and saying, is this the shoe that's going to drop, that's going to send things in a tailspin? And emotions get involved when it comes to our money. We see it on the financial planning side all the time. So that's what the last 3 years have looked like in the S&P 500. The last 10 years, 13.95%. That's an annualized 13.95% rate of return in the S&P 500. That's again, a very large number. And sometimes we forget how truly efficient markets are. If we go back the last 20 years, the S&P 500 is about 7.5%. And then when you look at it over the course of the lifetime of the S&P 500, we're at about 10.5. So, markets are super efficient, and there are always going to be factors that are going to, really have an impact on the rates of return in the stock market. So from a financial planning perspective, we always like to look at things as it pertains specifically to you, and make recommendations that are, again, uniquely yours. So with that, I'm stoked to have Jeff here. This is Jeff's first real Todd talk or anything along the lines there. And what we're going to do is we're going to start with Jeff's real overview as it pertains to inflation overall. So Jeff, if there's anything that you have in opening that you want to start with, please go ahead and do that, and then we can jump right in.
Awesome, thanks, Todd. And that's a good overview of the market. So where we've come from and where we're at today, and why this topic of inflation is actually it's really pertinent right now for where we're going the rest of this year. So what I wanted to do first is I really wanted to set a baseline and really define what inflation is. We hear about it; it's out there all the time. Fortunately, we've not had to really deal with it over the last 10 plus years, but it's rearing its head again for some various reasons. So I think starting off by defining it, and when we define inflation, really at its very base, it is too much money chasing too few goods. Now, put this another way: as inflation rises, our money, our dollar, can't buy as much as it does today, tomorrow. But not everything to do with inflation is bad. And I think that's what's kind of really, it's driving the headlines these days is this higher than what we've seen over the last 10 years type of inflation. Low, stable, controlled inflation around this 2% target that our Federal Reserve has out there. It's actually a good thing. Typically what you see with this is higher employment rates, steadier paychecks for employees, continued economic growth. There's nothing that's out there rocking the boat. It's a number that is just kind of ingrained in continued expansion of our economy. Inflation year over year, there's potential for employees to make additional wages. And the biggie behind inflation is those of us that are on Social Security, receiving Social Security benefits. This is what we see year over year in your cost of living adjustment. Now, if we take the other side of it, there's obviously some negatives that inflation, it brings to the surface. But this type of inflation, compared to the pros of it, it's this high, persistent, runaway type of inflation that really brings fear to the markets and fear to the people who study this on a day-to-day basis. Higher inflation, it means very basically that our goods and services are going to cost more. It may put a strain on the paychecks that we receive. Higher inflation historically has led to higher unemployment rates. Businesses, as they're dealing with these overhead costs, these rising overhead costs, they have to make decisions about their staffing levels. Can they do more with less to still make the numbers that they need to make? And also, as I alluded to before, rising inflation weakens currency values. That's not just a United States thing, that's a global phenomenon that happens. And unfortunately, the dollar that we have today is not worth as much, it's not going to be worth as much tomorrow. And you've probably seen some things out there. Inflation's been labeled this silent killer, the silent tax, and that is true. Inflation, where it is today, if we just have money sitting in a savings account, we're actually taxing ourselves by whatever that inflation rate is. And we'll get into some of those numbers in a little bit. But I really want to emphasize, we need to really pull back the curtain and look what's behind the scenes, what's driving inflation higher for us as consumers and investors. What's behind these prices? Has inflation been higher than average? Has it been running hotter than average for a period of time? Or is it more or less 1 month it's higher, 1 month it's lower, and it averages itself out, it works itself out? And really, and we're gonna hear more about this today from the Federal Reserve at 2:30 when they have a speech, but how the Fed is going to manage this. They've been trying to stoke inflation for years, and it just hasn't worked out. So one of the tools in their toolkit is they raise interest rates to combat inflation. Are they going to do that? Or are they going to let the market, again, work itself out over time, and things as these issues that we're going to get into in more detail work themselves out? Are we going to trend back lower toward a more normal long-term inflation rate? Now, getting into some more of these details and putting some numbers behind all of this, one key measure of inflation is the Consumer Price Index, or the CPI. It's a widely used metric. It's a monthly metric that comes out, and it is a direct reflection of us as consumers and investors, what we see in our day-to-day living expenses and expenditures. Think filling up your car at the gas station, think transportation, your food bill, your utility bill. You've probably seen the headlines out there, new and used car prices the last couple of years. Used car prices have actually jumped 31% last year, and that is reflected in this index. This index also reflects, again, those that are receiving Social Security benefits. This is reflective of your cost of living adjustment. One other index that we're going to talk about is actually, it's a spinoff of the CPI. It's called the core CPI. And what this index does is it actually takes out two categories, and those are food and energy. Now, the reason that they do this is actually these two categories are much more volatile in nature compared to what the rest of the index is comprised of. Take, for instance, if oil prices rise, you're more likely than not still going to go fill up your car at the gas station within reason. If it goes to $10 a gallon, you're probably going to hold off and you're going to probably stay at home and not drive your car. And you're more likely not going to put off buying groceries for an entire month because we all have to eat. And another interesting part of why these are excluded is that there's actually an active trading community behind these two categories that really there's traders sitting there at these institutional firms, and they're actually daily, weekly, annually going back and forth with where these commodity prices are going to be. And this leads to an increase in volatility. So what they've done is they exclude these two to come up with the core CPI. Now, where the CPI stood at December 31st of 2021, the end of last year, it was 7%. Core CPI stood at 4.9%. Now, let's compare these numbers to December 31st of 2020. The CPI was at 1.4%, and the core CPI was at 1.6%. Now, I know that kind of seems a little weird, but remember that in 2020, the energy market was actually in a pretty bad recessionary environment. So these numbers do make sense once you start to dig into them. Now, as you compare these numbers together, you can see why there's this all of a sudden this new heightened interest in where inflation is at. Just high level looking at these numbers, you can see that there's a very much a cause for concern with why, to understand why these numbers have grown as much as they have year over year. Now, let's take a look at these numbers for a second. Now, for those that were, unfortunately, they had to go out and they had to buy a car, that 2-seat convertible just wasn't cutting it. You're having a kid now, you're married. You had to go and buy the SUV or the minivan. This impacted you significantly more than those of us that could actually have a choice and not have to go buy that car. We can kind of sidestep a little bit of this inflationary impact. Another example of this would be those that are in the retirement phase of their lives, living on more of a fixed income, fixed type of income, and healthcare costs. Healthcare costs have, they've risen a little bit more than this inflationary number. But when you set out at the beginning of 2021 and looking at your budget of what you're going to spend on in regards to healthcare, and you look back at the end of the year, you've spent significantly more of your budget on healthcare. And that can be a little eye-opening as you go back and you look at that, because it may have been a shock to see that the numbers increased as much as they did.
Let's talk about this for a minute. So, you're bringing up a lot of good points as it pertains to the CPI. Most folks know what the CPI is because that's tied to Social Security, and we've learned about that over the course of time. And people like getting raises, right? Especially when it comes to government money. However, they haven't seen many raises over the last 5, 10, even 20 years due to the CPI staying so low. On the other hand, we know this when we look at someone's individual financial plan, that their actual personal inflation may be very different than what the CPI is or some factor that's being used for their Social Security. Inflation really can be broken down to an individual inflation rate. So your point about used cars, perfect example. If you didn't go buy a used car, you didn't experience a 31% inflation rate on a used car purchase. If you did, your inflation was probably much higher than the 7% that was reported.
Right.
Healthcare tends to run a little bit hotter than the CPI year over year. The cost of college tends to run a little bit higher than the CPI. So, your points are very good. And what we always like to do when we're talking on an individual basis to the clients that we work with is help them understand really what's their inflation rate and how does it impact them. So, your points are perfect because what you are saying is exactly what we see on TV, right? That's what we see in social media. It's what we see on mainstream media is they're reporting the broader numbers. And those, sexy 31% inflation numbers on used cars tend to get a little bit more attention than the, 0.8% increase that we saw last year holistically on the food side of things. But, again, all your numbers look great. Just want to reiterate that when we're talking about financial planning, it's individual as opposed to just, a broad scale CPI. But, these could very well come into play and affect people on that individual level. So Good stuff.
Yes, great points, Todd. And we'll, again, later on, we'll get into this a little bit deeper, how it affects us on more of an individual level going forward. Putting a little context behind this, a little history, a brief history lesson of why this is really gathering a lot of these headlines and a lot of the talking heads today, is that we have not seen this type of inflation since all the way back in the late 70s and early 80s. Now, it's a little bit different of an economic regime back then. We were actually coming down off of double-digit inflation in the 80s, and our economy was very weak. It was actually, we had a recession in the early 80s, unlike today, where we had a brief recession due to the lockdowns from COVID-19. But it wasn't because the economy was bad. It was because we were forced to. Now, just to dive into a little bit of what the 70s were. Now, I don't know if most of you know that the 70s, we had two energy crises. The unemployment rate hung around 7%. Inflation was actually averaged about 12% on an annual basis. Inflation was actually dubbed the enemy number one by the Ford administration at the time. They could not get a grasp around why inflation was sticking around and what to do about it. Amongst us as the individuals back then, our confidence in the government was waning. We could not get, we just started to lose a lot of faith in what the government said that they were going to do, that they were going to combat this. They were going to get more people back to work. Things were going to not be as expensive as they were, but people really felt like this was just part of the game. This was part of their day-to-day lives. Business investment slowed down. Our manufacturing sector, really that's when you started to see a lot of offshoring in that sector, specifically the auto industry, and productivity declined. As you can probably imagine, there was less people working and there was less people inclined to go and work then. Now, in 1979, a gentleman named Paul Walker, he became Fed chairman, and he had a new mandate that he was going to fight inflation with high interest rates, and no one was going to tell him any different. This actually was probably one of the causes of the recession that we saw then. But what he was able to do by raising interest rates higher than inflation and let it run its course is that the market started to figure itself out. By the time that his reign or the end came of his chairmanship, inflation was actually back down to the single-digit numbers. Compare that to where we're at today, and it's a much different environment that the Fed is trying to fight. Again, back in the 70s and 80s, we were fighting high unemployment and high inflation, along with interest rates that were much higher than they were today. Today, as most of you know, interest rates have been in this zero interest rate policy for quite some time. The Fed today is not fighting high unemployment. It's actually the opposite. We're pretty much at maximum employment. We have loose monetary policy, and I'll get into that in a second, and low interest rates. And it's been that way for quite some time. The start of all of this was back in 2008, the global financial crisis, when the Fed was out there lowering the short-term rates to zero, and then buying mortgage-backed securities and treasuries on the longer end out there to stimulate economic activity. And the Fed is actually, for years now, because of all that, we've actually been trying to get inflation to rear its head. We're finally seeing that today, but I think it's for different reasons than what the Fed initially had set out to do. A lot of this, how we got to the point we're at today, we can go back and let's just go back to the COVID-19 pandemic, the onset of that, and the response that just the U.S. government had with the pandemic. It was global. We had global lockdowns. Economies across the globe were much more interconnected than we were in the 70s. But what the U.S. government did is they helped stimulate or tried to stimulate our economy to ward off the worst of these mandated lockdowns by giving roughly $2 trillion of aid out, probably a little bit more than that, through a couple different mechanisms. The first was the CARES Act. And somebody can fact check me on this, but I'm pretty sure that this was one of the fastest bills to go from drafting, voting on, which was voted unanimously to go to the president, to get to the president's desk, to be signed and put into action. I believe it was 24 days for all of that to occur. This was roughly $2 trillion worth of aid. This was followed on in December of 2020 with the Appropriations Act, and this was another $900 billion. And this was given out not just to individuals, but it was given out to businesses as well. And it was given out to help ease the burden of these lockdowns, of the lost income, of the lost revenue for businesses. And this money came in a couple of different forms. First and foremost, it was stimulus checks to individuals. It was enhanced unemployment benefits for those that unfortunately lost their jobs because of this. That program actually ended in September of last year. The Paycheck Protection Program, PPP, for businesses. And for some people, there's a couple other nuances that actually got thrown in there, such as your mortgage and your student loan payments actually went into forbearance, and you did not accrue any interest. Now, keep that in mind for a second. I'm going to come back to that. So that environment, that March 2020, when we saw the recession, we were forced to lock down. People were relegated to staying at home. What they typically were spending their money on, think, your entertainment, travel, going out to eat, going and staying at a place, staying at a hotel somewhere else. People had money to spend, but they were forced to change how they were spending it. We weren't going out to eat anymore. We were probably cooking more food at home. We weren't going out shopping. There was not much foot traffic anymore in stores. We were, all of us, I'm sure, were using Amazon, and it was coming to our doorstep, and that's how we were shopping for a lot of our stuff. I know paper towels, toilet paper, and groceries, and you name it, Amazon had it for you. I know in my household that we had a lot of makeshift movie nights because we couldn't go to the movies with my two kids, and there was a lot of Disney Plus and a lot of pizzas being made just because we were forced to do that. We were forced to change how we went about hanging out on the weekend. And a major side effect of this is actually it's kind of a big positive in that savings rates of most individuals across the board went up. Let's think about that for a second. Imagine that you had a student loan payment previously. Let's say, let's just make it $1,000 a month. It's a pretty big number. All of a sudden, pandemic happens, these bills get passed, student loan goes into deferment, and you don't have to pay any interest on it. So you're not going to. All of a sudden, you have an extra $1,000 a month. That's kind of, it's found money almost, and it has to go towards something, whether that be savings, spending, paying down credit card debt, whatever it may be. There was extra money out there, and this actually happened to a lot of people. And that kind of, it plays into what we're seeing today. This extra money that was through the stimulus checks and some of this found money that is out there right now, it's actually helped a lot of individuals and a lot of households' balance sheets kind of right the ship. Because we weren't spending pretty frivolously on things that are out there. Again, going to concerts, going to ball games, you name it. We weren't able to spend on any of that. So there's extra money out there. And people actually had a little bit of a cushion to decide, if they did get laid off, then let me find a job that I actually want to do. Not that I have to do it. And this cushion has allowed people to really reevaluate going forward what they want to be doing. But on the flip side of that, those now our labor force is, unfortunately, it's becoming constrained. And that's had a direct impact on our supply chains. Now, if you guys haven't seen that, I would encourage you to definitely go and Google a picture of the Port of Los Angeles right now. And the sheer number of tankers that are docked in the pictures they're able to take. There's some that are actually even further miles out that have been asked to actually dock further out because there's just so much congestion there right now. And that's been going on for quite some time. And I say to take a look at that because it just gives a very clear picture of we are not able to get the goods that we're importing off of these boats to the ports, onto the 18-wheelers, to get to the warehouses, to get to the doorsteps, however the supply chain works. And that's directly affecting inflation. It's directly affecting everything from, you name it, food, electronics, lumber, microchips for cars themselves. We can't get enough of them to meet the demand or replenish the inventories businesses have drawn down throughout the last couple of years. Now, one of the key things that our supply chains need, and again, I'm just referencing the United States. This is a global issue. It's not really just centered around what's going on with us, but I'm just going to focus on the US for this. We need the right side, the supply chain needs the right staffing levels to get to work itself through and to get this bottleneck that we're seeing right now alleviated. As you can imagine, when one domino falls in the supply chain, it has a compounding exponential effect downstream. And right now, the big domino that fell again is those of us that don't want or don't need to work. And it's probably more for a lot of individuals. You know, it's probably more than just this financial cushion. This lockdown really made a lot of people reevaluate what was really important to them. The flexible work arrangements really made it. Do I want to make that commute anymore? Do I need to travel for business all the time? Families that sent their kids to childcare and daycare. Do I really want to do that? Do they need to go to that? Can they go to that? I know a lot of childcare centers, you know, parents are scared of sending their kids there in fear of contracting COVID. And that's all viable. But in order for our supply chain, and again, the supply chain is not going to fix itself tomorrow, next week, the month after. People that are out there studying this on a daily basis, they're estimating that it's probably at least a mid-year to end of year type of scenario that we're going to see a lot of these bottlenecks, these inventory levels of businesses that are waiting for their shipments right themselves.
All good stuff there, Jeff. You know, it seems as though when it comes to supply chain, because you hear about that just about everywhere, is that it's a domino effect. And there's actually a gentleman that I'm friends with who is a logistics manager for all those big ships that are coming over, not all of them, but that's what he does. And he was saying that not only is there a backlog on getting goods and services here, there's just a simple backlog of getting goods off the boat,
right?
Because of that labor shortage that you talked about. So even though, we're definitely seeing the impact of that. I don't know if anyone's gone to the grocery store recently, but depending on what time of the week you go and when you've been there, there's some empty shelves that, we're starting to see show up right in our backyard. So
yeah, very true.
So with that, the next item is, where are we headed? Where are we going?
Yeah, that's a great question. And I wish I had a crystal ball for that. But a couple of things right now that are happening. Again, we're going to hear a little bit more today with the Fed statements being released at 2 and Fed Chair Jerome Powell giving a press briefing at 2:30. But a couple of things are going to have an immediate impact on this trajectory of inflation. And most importantly, and emphasis on this, is what the Federal Reserve does. Now, just to define who the Federal Reserve is, it is our central bank of the United States. It is an independent entity from our government. And what the Federal Reserve has control over is our monetary policy. Monetary policy has a kind of a roundabout indirect effect on our economy, our inflation, our money supply, whereas our government has a more direct route to it where they're able to tax and spend. The Federal Reserve cannot tax and spend. And the two mandates that the Federal Reserve has is maintaining maximum employment, which they would probably argue, a lot of people would argue, we're pretty much there, depending on what you look at, and maintaining stable prices and moderate long-term interest rates. And now this is the part of it that them controlling inflation by controlling interest rates. The big thing that's coming out today, which is not one of their mandates, but it's one of the things that really drives the markets forward, is their guidance. If the Fed seems a little spooked today, thinks that they're going to maybe have to raise rates a little faster than the 3 that they're anticipating doing, that may make the markets a little jittery. It may cause increased volatility, more than what we've seen now, and it would be broad-based. It's not going to be relegated to just one sector. Now, the Fed meets roughly every 6 weeks. So this is the first of 8 meetings that they're going to have. And they should come out today and pretty much say what they're going to be doing in March. Now, in December, at their last meeting, they said that in March, they are going to stop this giant bond buying program that they've had in place since pretty much the 2008 global financial crisis. And think of that, it's QE 1, 2, 3, and 4. And that has thrown tons of money, trillions of dollars into the market to make sure that our economy keeps moving along and moving forward. This has more or less been a support to the markets. And every time over these last couple of years that the Fed has tried to stop and start to get rates off of 0, we've had a couple of taper tantrums. The market didn't like that. It liked the fact that if there's always a backstop to any type of negative ill effects that could rock the market, the Fed was always there as the backstop. Now the Fed is kind of changing its tune, as they've kind of been prodded along for quite some time now, to stop buying, stop expanding their $9 trillion balance sheet, stop buying these mortgage-backed securities and treasuries, and letting these roll off. Let the economy take care of itself. We don't need it anymore. The economy is good. We're on solid footing now. And what QE really did, it kept a lid on these longer-term bonds that are out there. Think, for example, how it affects us as a consumer. Think of your mortgage rate. We probably haven't seen or won't see again in the future as low as mortgage rates as we have. There's some out there. I know they have a 2.75%, 3%. These are extremely low. Let's go back to the example of the 70s. If you wanted to buy a house, take out a mortgage to buy a house back then, you were looking at 15, 16% on your mortgage rates. So it's significant if you look back at history and compare it today again. And what this was done, this whole quantitative easing, again, it was done simply just to make sure that the economy was stimulated. The global financial crisis, it really rocked us. It really took a lot of faith out of the markets. And because of this effect, because the Fed had was buying so much on a monthly basis, a year-over-year basis, it's really kept these long-term rates artificially low. So a lot of business, the theory is a lot more business would be done with the cost of borrowing money being low. The Fed has also said, and this is where I kind of, I look to, as far as a consumer investor, more to these short-term interest rates, because that is what we really will see in our day-to-day lives. We see this in our checking and our savings accounts. The Fed has said, they came out in December and said they're anticipating raising rates at least 3 times this year. Now, to put that into context, these rate rises are only 0.25%, 0.25%, 25 basis points. Where we're at right now on the short end of the curve is we're essentially at zero. We're at 0.08%. So these raises that they're talking about they're not giant by any nature. They're pretty well choreographed. And that's what the Fed is trying to do. They're trying to paint a picture of the road to get off of the Fed backstop. Now, what the market won't like with this is simply, if inflation remains persistent, it remains high for an extended period of time, the Fed's course of action, the tool in the toolbox that they have, is to raise interest rates more or more aggressively to combat and head off this inflation. Meaning, instead of a 25 basis point increase, we may get a 50 basis point increase, half of 1%. And it may be more than 3 times this year. And that is significant because, again, the higher interest rates are, the more expensive money becomes. And obviously, as a consumer, you don't want that. As a business, no way that you want that. You want as much cheap money as possible to keep your business growing. And so that's really what we're going to get a little taste of, a little flavor of today when Fed Powell comes out and gives the Fed outlook for at least March. The March meeting, it's pretty much baked in the markets that there's well over a 95% probability of the first rate hike, the first 25 basis points happening, and the Fed stopping their bond buying program once and for all. And what the Fed, many of you might have a question, well, what are they going to do with $9 trillion on a balance sheet? Well, a lot of that is they are going to be repaying the Treasury for the money that they use to buy all of these bonds, and they're going to let them roll off. They're going to let them naturally mature, and that's going to take some time to happen. $9 trillion is not just going to roll off because of all the different varying time to maturity of loans that they have. So the stimulus is not just going to stop as soon as the Fed stops buying in March, if they do stop in March. It's going to take some time, probably a couple of years, to really work itself out.
You're talking about the Fed raising rates. Talk about which rate they raise and where that rate is today, just to give some context to what you're talking about. And then before we move to the next subject, I'm going to touch on real estate for a second too.
Sure. Yeah, that's perfect. So yeah, as I said, rates right now, rates have been kept pretty much pegged to essentially zero. And what that zero is, that's the Fed funds rate. That's one of the tools that they can control. And that's the money that the banks out there, your JP Morgans, your PNCs, you name it, that's where they store their excess reserves overnight. And the Fed keeps that there, and that's what they're going to pay out. So in essence, like I had mentioned, this is what you're going to see. That's how you're seeing that 0.1% annual rate on your checking, or maybe you have a high yield savings account and you're getting 1%. That's reflected in this rate over here on the short end. And we've been at zero for a very long time. And the whole point of that, again, was to make sure that money was cheap. Money, what the Fed's actions were going to stimulate the economy. Unfortunately, obviously, that hurt us as savers. If we want to stick money in a savings account, that hurt us. We lost a lot of interest over the years, sticking money and leaving it sit in a savings account. And to relate it to the topic that we have today, inflation, again, if inflation is at 7% and our savings account is at 1%, we're down 6% just by having money sitting there in a bank regulated FDI insured saving or checking account. And it's unfortunate because that is a tax on us. That's a tax on our future purchasing power with that same money.
Yeah. So I had a chance to speak with Brian Italian, who is a mortgage loan officer with Pike Creek. And I asked him to give me his take on mortgage rates, because, that's the first thing that people think about. Oh, well, a lot of times it's the first thing that people think about along with savings account rates, because there's been jokes for years now, you put your money in a savings account, you don't get anything. But on the contrary to that, if you're loaning money, you're also loaning it dirt cheap. So what Brian mentioned was that mortgage rates are not directly tied to anything specifically that the Fed does as it pertains to the Fed funds rate. However, 30-year mortgage rates are usually pretty closely tied to the 10-year. All right. Ultimately, there's nothing that's a direct correlation, because the economic environment, inflation, interest rates, they all work together to help really determine what those 30-year mortgage rates are going to be. And we've seen this before. Mortgage rates can go up and can go down without the Fed's touching rates at all, because there really is no tie to that Fed's fund rate and mortgage rates. I also had a chance to talk with Vince Garman of the Garman Group. And he was telling me about how, the real pinch that we're seeing in inflation in the real estate market is somewhat three-pronged. Millennials buying their first homes, baby boomers really having an opportunity now to purchase a second home, and then investors seeing opportunity to really go out there and buy real estate as well, just trying to figure out where they can put their money. A lot of times investors look to put their money in something that's going to give them a yield. Well, savings accounts and those shorter term instruments really haven't done it. So it's pretty much been the stock market or the real estate market. And with that, we've seen the inventory, AKA supply and demand, the inventory where it normally sits at about a 6-month supply of homes on the market is really down to about a 1-month supply, which is why we're seeing these homes go for, higher than asking price in some cases. So, depending on what we see with inflation, this may slow things down. It may, continue for a little while, because, with anything market related, the market dictates how it's going to digest the information that comes through. And I know we're going to talk a little bit more about, what we see when there's, monetary policy that's sort of a tightening effect, and what that looks like with the stock market. So again, that's just a general overview and some of the professionals that we work with as it pertains to the real estate market. So I just want to share that.
And I think that's a great segue into this next topic that I kind of want to talk about. Is this inflation that we're seeing today more transitory, or is it more persistent? And what you just discussed, Todd, that to me, that falls more into that persistent camp. Is there something structurally changing with our economy that's maybe make inflation linger around higher for longer? And a big topic there is the housing inventory, whether it even be newly built homes or the existing housing stock. There's been instances that we've heard that there's been 5, 6, 7, 10 bids on one home, and that's a reflection of the inventory that's out there. And what is that going to do? Well, if you're selling a home, you love seeing that. You love seeing bids coming in higher and higher and higher, and you're probably going to sell it to the highest bidder out there. Why wouldn't you? But is that something more structural that's going on? Is there enough housing stock out there, whether again new or existing homes, to meet the demand that we have as Americans? The trend has been, we are behind the 8 ball in new home builds across the country, and that is directly reflected in higher new home prices. A lot of millennials, we've felt for years that we've been priced out of the market for just a starter home, And that's a reflection of the existing housing stock. People are either, they're downsizing, or there's just more people that are looking to really just maybe get into a different type of home. And that's really keeping a pretty large swath of consumers out of the market, even though they want to be in. And that's in that persistent camp. Is there something structurally changed? Has something structurally changed to our economy that's going to cause inflation to stick around higher for longer? The other side of it, and this is where I think that we're at today, is the transitory camp. I know we talked about the supply chain issues. Businesses cannot keep enough inventory on hand. It's drawn down too quick and things are out of stock. Todd, as you said, you go to the grocery store, depending on the time of week, there might be empty shelves. And maybe some of you have seen that. I know I've seen that. Things are just more expensive right now. But the transitory camp, it's interesting because I think we have to be there right now, because I think it's the low man on the totem pole. I think it's the low hanging fruit of explaining why inflation is what it is today. I think that once this clears up, once the supply chain figures itself out here, I think that we're going to be able to eliminate one of the reasons for this high inflation. We're able to cross it off. And I think the transitory camp this is near term elevated inflation due to the supply chain. But once we get past that, maybe there is something more structural going on. Maybe there is a change in the guard, for lack of a better phrase. Because not only home prices, we're seeing home price inflation, we're seeing wage inflation as well too. Again, it goes back to right now, the Great Resignation happened. People are now sitting there, they're sitting on a little bit of a cushion of money, and they're deciding what they want to do next. Is it going to the office 5 days a week? If there's an alternative that they have to just be in twice a week and they can work remote or work from wherever, that probably entices a lot more people. They have the flexibility now to really sit and figure out what they want to do. Now, on the other side of that, the employer, they're having to raise wages to entice people to come back to work, to have people do what they need to do. And that's raising wages across the board. And is that something that we're going to see going forward? You guys have probably heard of the gig economy. A lot of people like to do these short-term contract work, and they're fine with that. They're fine going from one assignment to the next and not knowing what's next after what they're currently working on. And that's all fine and good. Technology has enabled us to do that. But is it going to have an effect on the structural component of our economy? And those businesses that are really driving our economy forward, they're going to have to make some decisions on what they do. At some point, you would think that wages would have to stop rising and businesses would start to consolidate, how much staff they really do need to do the projects that they have going on to drive their business forward. We don't know yet. We haven't seen it yet. Where we're at currently is that wages are rising, and the cost of living adjustments happened last year. We saw a little bit of a raise. It was a cost of living adjustment to combat some of this inflation we saw. So that structural side, I think that's more long-term in nature. And it's something that I think that those guys out there that study this every day, they're going to take a harder look at that once we get through this supply chain issue, the low-hanging fruit, like I said, we get on the other side of that, and the supply chain starts operating optimally again.
Couldn't agree more, Jeff. It's definitely something that's going to work itself out no matter what. So, all right, as we get to the next item on our list, the talk of recession. So, you and I both read a piece by Goldman Sachs. It's nice and big and thick, and the outlook, you can't see it because I'm blurred out, but lots of pages. Piloting through is the title of it. Why don't you talk a little bit about that, what the outlook is, kind of where we are, and what's going forward here from the perspective of the Goldman Sachs folks?
Sure, absolutely. Yeah, that was a great article. Yeah, it was a number of pages, but it was all good stuff. And really the big takeaway was kind of what during your opening, you kind of alluded to it. These past 10 years, these past 3 years, we've seen double-digit growth in the S&P 500. We've seen phenomenal returns. And at some point, you would have to imagine that, it reverts to the mean. It slows down a little bit. Can we keep growing at 20% annually? Probably not. But you have to keep in mind of, what we were coming off of in 2020. We hit one of the quickest recessions of all time. And coming out of that, before that, our economy, we were rocking. We were doing really good. after that, we were trying to just get our feet back under us and get back to where we were previously. Now, the outlook that Goldman Sachs had in this piece, their base case scenarios, we're going to see, the high single digits, maybe possibly low double digit returns this year overall for the market. Within their base case scenario, they have a less than a 10 or 15% probability of a recession. And that is because right now we're still trying to really come out of this 2020. We're still not open yet. We're back wearing masks again. There's still restrictions on a lot of things, on travel, on amusement parks. There's a lot of things that still haven't come back online fully that are going to work themselves out as we further distance ourselves from the lockdowns of 2020. As far as the markets themselves go, I know a lot of you probably have seen the start of this year. It's been pretty rocky. And most of that can be explained away by the fact that the Fed has guided us to rates are going to rise. And as I said earlier, as rates rise, money becomes less cheap. It becomes more expensive to do business. For over a decade plus now, we've been in a zero interest rate policy environment, meaning money has been cheap and businesses really could depend on the Fed to keep that money cheap so they could continue to grow. Now, the math behind all of it, it's a little bit convoluted, but essentially, since we've been at basically zero, the future value of a lot of companies, a lot of high growth companies, it's pretty much infinite. Now, I know that's not realistic, but that's really how the math boils down. As interest rates rise, that discount factor, which is, and another term for that is the risk factor of future cash flows, it starts taking all of that future money that's expected, that value of the company in the future, and it starts knocking it off. It becomes harder and harder to get that next dollar. And that's really where we're at right now. We've seen a lot of those, the names that you guys are all probably familiar with, your Facebooks, your Amazons, Googles, you name it. They've really taken it on the chin at the beginning of the year because of these expectations. It may be a near-term reaction. It may be some profit taking, getting into some other sectors of the rotation into other sectors of the market that actually do well in a rising rate environment. But ultimately, the year-end targets for the majority of those strategists out there that, they put a number out there, we're going to see positive returns again, at least for another year. And again, the crux of this is really the forward guidance the Fed is going to give us and whether or not we can keep this inflation maintained.
Yeah, one of the other items that I thought was interesting is, when Goldman Sachs went back and looked at the last 15 tightening cycles on monetary policy, which are all post-World War II, 9 of the cycles led to a recession, which is 60%. But like Jeff said earlier, that's as tightening gets, more accelerated and isn't happening at the controlled pace that's projected. It's where that's more likely to happen. So the greater number of hikes we see and the longer the increases last is where we're more likely to see a recession. And currently, based on what the current projection is, we don't see that. Goldman Sachs even said too, a recession in 22 or in 2023 is highly unlikely. And from the beginning of the tightening policy, we typically see the stock market run another 30+%. So again, this is all past data. This is all just information that we're passing along. But the really bleak outlook that we've been hearing about inflation overall and what it could do to the market, when you put a little bit more context behind it, it doesn't seem quite as bad. And it seems like, we may in fact be in that transitory environment that Jeff's been talking about. So, all right. So, Jeff, I know that there's a couple other things on here. One being, what does the higher inflation mean to you? So, if you want to finish with that, or if you want to touch on anything else, I think now's the time.
Yeah. So just to touch on how it affects us, as we said at the beginning of this talk, higher inflation, it's not necessarily a bad thing. It can actually be a really good thing depending on what's behind it. The cost of living adjustment for those receiving Social Security benefits for this year was 5.9%. That's an extremely high number, but unfortunately, that's a reflection of obviously the cost of living, but the cost of buying things, inflation. It's a direct reflection of that. And having said that, for the foreseeable future, things are going to be more expensive until we can, again, alleviate these bottlenecks in the supply chain and businesses can get back to having full inventory. And if you take another step back from that and think of our GDP and what comprises of that, 70% of our GDP is consumer driven, what we buy. If inflation continues to trend higher, we may start seeing more people putting off those larger purchases. Right now, it doesn't seem like that's stopping. The increase in prices is stopping anybody from making that next car purchase, that next home purchase. We're not at that point yet. So the effect that it's going to have on the total economy, I don't think that there's much there yet. Again, I think this transitory camp, this is going to be some near-term pain, and we're going to start to trend back lower. We kind of touched on the markets and the portfolio of how inflation affects that. Again, those high growthy names, those household names that you hear about pretty much daily from all the talking heads, those are starting to come in a little bit because, again, just remember that next dollar, as interest rates rise, that next dollar of revenue these companies are going to try to earn, it's just going to become that much more expensive. It's going to become a little bit more difficult for them to justify their high valuations going forward, unless they can continue to prove that they're just money-making machines. One other interesting part of the market is the fixed income component of it. For the last 40 plus years, we've been in a one-way bull market as far as fixed income returns. One of the big indices out there, the Barclays Ag, it's actually returned over 7.5% over that 40 years. It's phenomenal. But now, since basically we've gone from double digit all the way down to zero, we're at zero now in terms of where we have to go. We are at the bottom, and there's only one way to go. And that trajectory is the other way. And keep in mind, think of fixed income, it being on a seesaw, prices and yield. As price goes down, yield goes up. As price goes up, yield goes down. And it's going to be a tricky component going forward as far as how the fixed income markets react to these rising rates. It's going to be a little bit, not a new paradigm per se, but it's going to be a little bit more intricate of how positive returns are going to be received going forward in a rising rate environment. It's not to say that fixed income is now, it's going to change from being a ballast of a portfolio. No, it's completely going to remain that. It's just going to be the return component of fixed income is going to change a little bit. And one last thing that I want to leave with is just the simple fact that, being invested in the market, when you see a red day, it can be really unsettling. You string a couple of those together like we've seen this year so far. I think it's been 7 straight days we saw at one point in just the first 3-4 weeks of the year. It's really unsettling. But by sticking with your plan, it's going to leave you in your best position to capture the majority of the recovery. If we start trying to time the bottom, time the tops, it's almost a fool's errand to do so. There's a lot of money, a lot of institutional money out there writing crazy algorithms and a lot of computing power behind it, and they can't even get it right. So if this is really unsettling and you start to think about trying to pull money out of the market, you have to get 2 things right. You have to get the top right, and you have to get an entry point. You have to get the bottom where you think all the selling has been done. So to answer one question, you have to get 2 parts of it right. And that's really hard to do. And people have tried it. The people that have actually made out better and on the good side of this have actually been the people that have stayed long-term investors and stayed invested through any type of market turmoil or market downturn. And just one final little tidbit, by missing just the 10 best days in any given year of market return, the probability of you missing or having a positive return that year almost goes to 0. So again, it just emphasizes the fact that market timing, while we all probably have tried it at some point or another, it doesn't generate those excess returns that we tried to sidestep. It just, for the most part, is not a successful strategy. So Todd, with that,
Jeff, your closing sounds more like a CFP closing than a CFA closing because you couldn't be more right there. I'll never forget a conversation that I had with someone. I think it was either 2010, 2009, whatever it was. And the market that day had a terrible day, and I got a phone call, and the person was extremely frantic and said, "I want to pull all my money out of the market and this, that, and the other." And so what happened? What happened? And they said, well, the market's down 6% over the last, week and a half. I said, okay. We looked at their portfolio. Their portfolio was down 0.3%. So it's very important from a financial planning perspective to understand your situation, understand what you are trying to do correctly. Obviously, here at Blue Rock, our goal is to make sure that you've got confidence in your plan. You have everything set up before something goes way up or way down for that matter, and that you still have money in your most important account, which as always is going to be that checking account. So, Jeff, thank you so much for being part of our financial planning Todd Talk. We might have to make a Jeff Talk or something after this so that you can have your own little commentary. But appreciate you.
Thanks for having me.
Appreciate you taking the time out. I know that this is recorded, so we're going to go ahead and get this available publicly. We'll put it out on our social media. If you haven't already, follow us on LinkedIn, Blue Rock FG on LinkedIn. We're on Instagram, Blue Rock FG. We're on Facebook, Blue Rock FG. And we try to put little pieces out all the time just to help everyone stay up to date on what's going on. And if you have an idea for a Todd Talk or a Jeff Talk, by all means, let us know. We'd love to accommodate and bring some more insight to you. So that's all we got. Appreciate the time. Thanks, everybody. Jeff, thanks again.
Yeah, thank you. Thanks, everybody. Appreciate it.